If you are an Australian senior thinking about retiring overseas, stop scrolling for the next 10 minutes, because what I am about to tell you could save you from a Centrelink debt letter, a frozen bank account, or worse, losing your age pension altogether without even realizing it happened. This is not scare talk. This is exactly what is happening right now to Australians who packed up their lives, moved to Bali, Thailand, the Philippines, Portugal, or back to their home country to be closer to family, thinking their pension would just keep rolling in quietly in the background. It doesn't work that way anymore. The Australian Taxation Office and Services Australia share data. Immigration records your departures and arrivals automatically. Banks report large transfers. And if you think nobody is watching that account back home while you're sipping coffee on a beach in another country, I need you to hear this clearly. They are watching. And the rules changed again this year. Welcome back to Centrelink Age Pension, the channel where we cut through the confusing government jargon and tell you exactly what you need to know to protect your payment, your savings, and your peace of mind in retirement. If this is your first time here, hit subscribe, because every single week we break down exactly what Centrelink and the ATO don't put in plain English on their websites. And if you're one of the thousands of Aussie seniors dreaming about retiring somewhere warmer, cheaper, or closer to family overseas, today's video is one you cannot afford to skip. Let's start with the biggest myth out there. Many pensioners genuinely believe that once you're overseas, Centrelink loses track of you. That belief is costing people dearly. The truth is that Services Australia and the ATO exchange information constantly. Your movements in and out of the country are recorded through the Department of Home Affairs the moment you cross the border, and that data feeds directly into Centrelink's system. So when you tell your neighbor you're just going for a long holiday, but you've actually sold the house and you're not planning to come back, Centrelink already knows the pattern doesn't add up. This is not paranoia. This is standard data matching that has existed for years and has only gotten more sophisticated. Now here is where it gets serious for anyone planning a permanent move. If you are living overseas short-term, say up to 6 weeks, your age pension generally continues as normal. But once you cross that 6-week mark, you are required to notify Centrelink, and depending on how long you're away, your supplementary payments can start to change. As of the rule update taking effect in September this year, the short-term travel window before your pension supplement is affected has actually been extended from 6 weeks to 12 weeks, which is good news for pensioners taking longer holidays. But don't get too comfortable, because if you are still overseas after 12 weeks, your pension supplement stops completely. And if you have made a permanent move rather than just traveling, that supplement can stop from the very day you leave, not after any grace period at all. Then there's the 26-week mark, and this is where things really start to bite. If you remain outside Australia beyond 26 weeks, your payment is reassessed based on something called your Australian Working Life Residence, essentially the number of years you lived in Australia as a resident between the age of 16 and pension age. If you haven't accumulated the full residency requirement, which is generally around 35 to 45 years depending on your circumstances, your pension can be reduced, sometimes significantly. This isn't a random cash grab by the government. It's built into the pension formula itself, and most retirees find out about it only after they've already made the move, which is exactly the mistake I want you to avoid today. On top of that, your energy supplement stops the day you leave to live overseas permanently. Your concession card, the one that gets you cheaper prescriptions and utility discounts, gets canceled. If you're receiving a carer allowance for someone, that payment ends too the moment either of you relocates overseas. These are not small details buried in fine print. These are real fortnightly reductions to money you were counting on to fund your new life abroad. So why is the ATO specifically watching your bank account? Here's the part most people don't think about. Even after you leave Australia, if you still have bank accounts, investments, superannuation, or property here, the ATO continues to monitor activity tied to your tax file number. Large or unusual transfers, foreign income you haven't declared, or a mismatch between your declared residency status and your actual banking activity can trigger a review. Australia has strict foreign income reporting rules, and if you become a foreign resident for tax purposes while still holding Australian assets, your tax obligations can shift dramatically. Interest earned on Australian bank accounts, for example, can be taxed differently once you're classified as a non-resident. Miss that distinction, and you could end up with an unexpected tax bill or find your accounts flagged for clarification. Financial institutions are also required to report certain transactions, and international transfers above set thresholds get picked up by data matching systems designed to catch exactly this kind of movement. This is why so many retirees who move overseas without proper planning end up blindsided. They assume that because they're no longer physically in Australia, they're somehow off the radar. In reality, the systems tracking pensioners and taxpayers have become more connected, not less. Your passport movements, your bank transactions, your declared residency, and your Centrelink payments are all pieces of the same puzzle. And when those pieces don't line up, that's when you get a letter asking you to explain yourself, or worse, a debt notice demanding repayment of money Centrelink says you weren't entitled to. Here's what you actually need to do if you are seriously considering retiring overseas. First, before you book that one-way ticket, contact Services Australia directly and find out exactly how your specific payment will be treated based on your residency history and destination country. Some countries have social security agreements with Australia, including places like the United Kingdom, New Zealand, and several European nations, which can allow your years of residence to count differently and sometimes protect your payment rate. Not knowing whether your destination country has one of these agreements could mean the difference between keeping your full pension and watching it shrink dramatically. Second, always report your travel through your Centrelink online account via MyGov, using the Travelling Outside Australia service or by calling Centrelink directly. Do not assume they already know, and do not assume a delay in reporting won't matter. Failing to report changes in your circumstances is one of the most common reasons pensioners end up with an overpayment debt that Centrelink will chase you for, even from overseas. Third, speak with both a financial advisor and an accountant who understands cross-border tax residency before you make the move. Your superannuation, your investment income, and your tax residency status all interact with your pension in ways that are easy to get wrong and expensive to fix after the fact. What feels like a simple lifestyle decision, moving somewhere with a lower cost of living and better weather, actually triggers a cascade of tax and pension consequences that most people only discover when it's too late to undo them cleanly. Fourth, think carefully about healthcare. Once you're overseas, Medicare doesn't cover you, and while Australia has reciprocal healthcare agreements with a handful of countries, those agreements typically only cover emergency treatment, not ongoing or serious medical care like cancer treatment or major surgery. Many retirees who move overseas without private health insurance in their new country end up flying back to Australia for serious health issues, which defeats the purpose of the financial savings they were chasing in the first place. And finally, if you do return to Australia after living overseas and start receiving your age pension again, be aware that leaving the country again within 2 years of your return can cause your payment to stop entirely. This rule exists specifically to prevent people from bouncing back and forth to game the residency requirements. So if you're not fully committed to staying, think twice before restarting that payment. I know this is a lot to take in, and I know the idea of retiring overseas is genuinely exciting for so many of you who've worked your whole lives and just want more freedom, more sunshine, and more time with families scattered around the world. That dream is absolutely still possible. But it has to be done with your eyes open, not blindfolded by assumptions about how the system used to work 10 years ago. The ATO and Centrelink are more connected than ever, and the pensioners who protect themselves are the ones who ask the right questions before they leave, not after they get the letter demanding answers. If this video helped you understand what's really at stake, do me a favor and hit that like button right now, because it genuinely helps this channel reach more seniors who need this exact information before they make a costly mistake. Subscribe if you haven't already, turn on notifications so you don't miss next week's breakdown, and drop a comment below telling me which country you're considering for retirement, because I read every single one and it helps me know exactly what to cover next. Until next time, this has been Centrelink Age Pension, helping you protect what you've earned. Stay informed, stay prepared, and I'll see you in the next video.